In this video, we're discussing the prospect of selling a Amazon FBA company to Acquco, Thrasio, or Perch. These are three companies that are in the business of buying and operating FBA businesses. Perch was founded in 2019, and they have a website that says you can sell your FBA business in 3 easy steps. Thrasio is the oldest of the three. It was founded in mid-2018. They also want to buy and grow Amazon businesses. Acquco is the newest entry in the marketplace. They were founded in 2020. And seamlessly exit your Amazon business in less than 30 days. All three of these companies essentially want to acquire FBA third-party sellers and operate them. Now, what do these companies actually do? Well, since the fastest growing consumer channel in the United States is Amazon, and the fastest growing sector of Amazon is the third-party seller, these three companies are focusing on acquiring companies in the fastest growing sector in the United States, which is e-commerce third-party sellers. Now, these companies actually are really taking the place of private equity companies, or companies that are looking to acquire companies and take them public. Now here we have the world's top private equity funds. Many of these funds are the people who are actually backing Perch, Thrasio, and Acquco, because they need capital in order to acquire these third-party sellers on FBA. Now, what do these three companies, how do they make money? Well, essentially, they want to acquire these third-party sellers and operate them and grow them up, the same as a private equity firm would want to acquire a traditional business, a manufacturing company or a retailer of some sort. And then they want them to get to a certain revenue number. Now, what revenue number is that? Well, they're looking to get to this $100 million mark because they want to take the company public. Eventually, this is the goal. But they need this much revenue from a company in order for it to go public. So these FBA third-party companies that Perch, Thrasio, and Acquco are trying to acquire don't have $100 million in revenue. So they want to buy them and then combine them with other companies in the sector or to grow them up to reach $100 million. Now, it's not likely that they can grow a single purchase into $100 million. So they're going to strategically hope to acquire companies in the same sector, such as consumer goods or sporting goods or industrial products. By combining companies together that make and sell similar things, they can hope to get to this $100 million sales mark, so they can take the company public. Now, why would they want to go public? Well, this goes back to how they value your company and how they essentially are going to make their money. Acquco here on their video says that if your company's revenue is $2 million and your earnings before interest, tax, depreciation, and amortization is $425, then your sales price will be $850,000. Your inventory value they're estimating is about $400,000, and they're paying you $1.25 million. Now, this is a lot of money, but from a percentage of revenue, it's about half, a little more than half of that. Plus $400,000 of it is the inventory. Now, what do publicly traded companies sell for? What do they trade at? What is a good price to sales ratio of a publicly traded company? Well, if we look here today, the ratio is 298. This means that the company's stock on the S&P 500 currently is trading at a 2.98 multiple of earnings. Now, that's a historic high number, really, since back in 2002, it was much lower. In the in the real estate crisis, it was down to 0.8, but in recent years, it's been 1.8 to 0.0. So let's just imagine what today's price is at 3 times earnings. This means that a company that's earning $2 million would actually sell for $6 million. But Acquco is going to pay $1.25 million for something they know could essentially be trading at 3 times earnings, meaning their stock price would be worth $6 million. This difference between the 1.25 and the $6 million is where these 3 companies are interested in making their money. Now, this conversation is not a negative conversation, because if the company could go public all on its own, it would do it. But since the company is not at 100 million revenue, somebody has to do the hard work. Now, we would encourage the company themselves to maybe continue to grow. The bigger this number is, the bigger the buyout will be. So, is there another way? Well, there is another way. NowFactory can assist companies in streamlining their assembly, streamlining their packaging, and taking these services offshore with our Dragon Factory service. This is where we connect you with top factories in India, top factories in China, where the labor cost is 10% of the U.S. cost, where the cost to produce products is substantially less. We can raise these revenue numbers up, we can raise these margins up, and we can push back the time that we need to make the decision to call one of these 3 companies. Because ultimately, the longer an FBA seller waits to make this phone call, the bigger this number will be. Generally, people think of exiting their business when they can't see future growth, and NowFactory can help continue that future growth without having to sell the company to one of these FBA acquiring entities.